Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about kind of the markets, the stock markets, and your investments play such a large part of your retirement plan. I would say it plays 90%, right? Health is some of it, but money is a big factor. Obviously, if you don't have your health, we did a video last week. If you don't have your health, money is worthless too. But as you plan out, you assume you take care of your health. You need to take care of your assets. And last Friday we triggered a point in the market where the market dropped 2-3%. And it's days like that that can cripple your retirement if you make an irrational behavior, which most of you don't, but a lot of you do, or at least you think you need to, okay? So when the market drops, a lot of you say, it's going to go further down, and it might. We don't know what it's going to do. But as you'll see here, you'll see in these charts, right? Like if you look short term on these charts right now, basically you'll see, if you zoom in too much, it's just a downward trend. But as you zoom out, you'll see stock markets will go up over time. That's just the trend of stock markets. Now, there's good times and there's bad times. Now, the purpose of today's video is to really talk through the psychological part of a financial and retirement plan surrounding your investments, okay? During the 2020 crash, when COVID hit in March, April, we had a lot of clients calling our office, calling our portfolio managers saying, Adam, how does this affect my overall retirement plan? Calling BCV saying, should we sell? Should we adjust? What needs to happen? BCV's standpoint. So BCV Asset Management is one of the portfolio managers that we refer clients to. They do a great job managing money. They manage my own personal money as well. And, they buy blue chip dividend paying stocks. So what happened in this time, I'll give you an example of my portfolio. We basically shuffled any fixed income that we had, which wasn't a lot because I'm a bit younger, but any fixed income in my portfolio, we shuffled into equities, okay? Basically, I looked at it as, hey, look, I have a long time frame. Let's put everything in the market. Everything's on sale right now. Now, a lot of you watching this video are close to or maybe in retirement. And I think this fallacy of, hey, when I hit retirement, I need to make sure my money's safe. I need to pull out my money. And the reality is, if you do an RSP meltdown, delay your CPP, and do a lot of the strategies that we talk about that make a big difference in how much tax you pay and how much income you get in retirement, the reality is you will probably pull out your RSP depending on how much there is, over the next 5, 10, 20 years. But you may not be using all that. You may be reinvesting into a TFSA or a non-registered account. My point is, even when you hit retirement, you're not needing all your money. Okay, you're probably needing between 3 and maybe up to 8% of your portfolio on an annual basis. Okay, basically over 90% of your portfolio is untouched. So if we have days like last Friday when the market's down 2-3%, it shouldn't be cause for concern. It should be cause for, hey, let's review my portfolio to make sure that I'm structured properly for these days, and hopefully that's done before those days happen, okay? But those days, like last Friday, down 2-3%, shouldn't be days where it's like panic, sell out of the markets, because you know what happens? You miss Monday. Monday, so far, I'm recording this on Monday morning, so far it's up today. So you don't want to panic and get out of the market. Now, we had people reach out to us in summer of 2020 that were not previously clients of ours that did exactly that. March, April hit in 2020, they panicked, they sold, they went to cash. And you know what? Yeah, sure, they missed a bit of that downside, but they missed that V recovery, right? And by the time they called us and we got them reinvested, we reinvested them, back in the markets, BCB did in this case, but it was actually higher than when they got out of the market. So, they've since made a lot of their money back. It's been good market since then. But the reality is that split decision to have, let's panic, let's sell out, let's get out of the market, it derailed their retirement plan, okay? Now, fortunately, they made that call within a few months to me. We got them on track. We built a financial plan, and we've actually got them back on track, and they're going to be able to retire on time. But a lot of you panic. You sell out of the markets. When do you get back in? How does that work? There's a lot of planning around that. And, getting out of the market probably derails your plan much more than just riding out the market. Again, even if you're in the point of drawing down your retirement income, you're probably only touching that 3-8% of your portfolio. So let the rest ride. If you have a financial plan, so when we map out a financial plan, and I'm doing a video in a few weeks from now, I'm going to walk through our financial planning process, and you're going to see our software, how it works and all this, and I'm going to explain the details. It's going to be a bit of a longer video, but I want to go through that process because I think every single one of you watching these videos needs to go through that process. Whether it's with us or your financial planner, it doesn't matter. You just need to go through the process. In that process, we'll average out an investment return, but we account for the ups and downs on the market. If you're conservative, if you say, look, we expected a drop, right? Maybe 2022 brings a down market. Maybe we're down 10%, right? Well, 2021, hopefully you've made 10, 15, 20% if you're invested in a balanced growth investment portfolio, right? So everything levels out over time. Don't let these down days or maybe down weeks or down months discourage you from being invested and pull out and go to, say, an annuity or something that's paying you, less than inflation, okay? Don't let that happen to your portfolio. I remember 16 years ago when I got into the business, one of the first charts that someone gave me in the industry, it was a mutual fund salesperson at McKinsey, and I sold mutual funds back in the day. And she showed me this graph, and it was, look, if you got to show your clients that trying to time the market just doesn't work. It's time in the market, not timing of the market. And over the last 16 years, I've seen that firsthand. Through 2008, 2011, 2015, 2018, 2020, these were bad years in the market, especially 2008 and 2020. Those that kind of just held the ship, had good investments that just rode it out, are way better off on the upside versus people trying to get in and out of the markets. And there's this graph, I'll throw it up right now. It talks about missing the best days. And you can see the difference. If you miss the best days in the best 5 days in the market, the difference between your returns, okay? And a lot of people think they can time the markets in and out, and it's just challenging to do. Sure, if you do it right, you may be a bit ahead, but you're better off time in the market, not timing of the market. So, and why this is all so important as part of your financial and retirement plan is if you start bumping into the market, that could drastically hurt your overall portfolio, your portfolio return, and thus your income plan, okay? So you need to make sure you have a clear income plan. And I'm going to do a video in a couple days from now that talks about how to draw money out of your portfolio in retirement. And it's a struggle that we see people face every day, and we've really been bumped up against it lately. So I want to break down a video, again, that's going to come out on Friday this week, on how to, when you hit retirement and you have all these stock holdings or whatever you have, how do you draw this out? How do you create income? And part of that is making sure you have some cash aside. So we'll go through that video on Friday. But make sure when markets do crash that you don't panic. If you miss those up days, okay, sure, you may miss another down day, but we don't know when the market's going to dip. And 2020 was the perfect example of that, right? That it was, I remember early days, day 3, 4, 5, a lot of the economists were saying, like, is this going to be a V recovery, a U recovery, a W recovery? And it ended up being a V recovery. And it was straight down and almost straight up. And we've been straight up since then. Last Friday was one of the worst days we've had in a long time. We're going to have more of those, okay? On average, the market drops at least 5% twice a year, okay? On average. Now, the market drops at least 10% every 2 years, at least every 2 years, okay? So we see these drops, right? Again, I'll throw up a chart right now again that just shows how the market goes over time. You can see it's not a straight line up, it's not a straight line down, but it's a trending line up with some down market, okay? So I really want to stress, when we have days like today, or days like Friday, you're going to look at your portfolio and say, man, like, I had a client text me, like, oh, we're down $27,000. It's like, I know. I don't like to see it either. My portfolio is down. Your portfolio is down. We never like to see it. But I also understand that you need things to go down for things to go up, right? Market corrections are part of the overall ebb and flow of the market, right? It's like, think about your relationship. If you're in a relationship, if you're in a marriage, you know this, okay? You need those bad times to really, come together to make good times, right? Like, when you have tough times in your relationship, usually it's better on the other side. If you can get through it, it's a lot better on the other side. And, cue the comments below, yeah, it got bad and I got divorced and now everything's a crumble. Okay, I get that happens. But, if you look at a good relationship, how did you build that over time? Ask someone that's been married 40, 50 years. Okay, if I ask my grandparents, what really created your marriage to be so good, so strong, like so deep? And they'll say, you know what, it was a tough time. And my grandparents had a bunch of tough times, personal, business, all that. So it's a down and then it's higher, down and higher, okay? It's the same with your stock or your investment portfolio in retirement. And again, remember, that down, prepare for that. If you have a financial plan, you're going to see, hey, next year I need to take $20,000 out of my RSP. Make sure that $20,000 or maybe even $30,000 to $40,000, so you have up to 2 years of income, is protected from the market, okay? The rest of it can ride with the market because you're not touching it for 2, 3, 4 years or more, right? You can let it ride back up and see that long-term gain. The last thing I want to say on this is, as you build out a financial plan, you want to use a conservative rate of return, okay? So when we build out plans, we typically will use 5 up to 6% rate of return on investments, net rate of return on investments, okay? Now, if we use 5%, okay, and we look at 2021, and our clients have said, hey, I've done 15, 20%. Okay, well, we're averaging 5%. So what does that mean? Well, we're going to have some down years. We need to average that out. Now, hopefully we average better, obviously. But if you plan conservatively, when you have these years of 10, 20% return, expect a bit of a pullback on the other side, okay? Again, the ebbs and flows of the market. Don't beat yourself down when the market's down, okay? It's part of the process. Again, if you have a clear plan, okay, the solution to the down days in the market, now listen to me carefully here. The solution to the down days in the market is to have a clear financial and retirement plan going forward. Okay, so if you're retired and you know that you need say $20,000 from your RSP next year in 2022 and 2023, you should have that put aside either in cash, in a liquid or maturing bond, something liquid, something that's not tied to the stock market. It may not be earning you a lot of return, but it's protected against ups and downs in the market. Okay, that's your cash flow, and again, that's probably 3 to 8% a year. So call it 10, maybe up to 12% of your portfolio is in cash or a cash-like investment. Okay, that means that the majority of it can still be invested. Okay, so make sure you have a retirement plan. Now, if you're not yet retired, let's say you're 30, 20, 10 years from retirement and you're saving away, have an ongoing savings plan. Okay, days like Friday, personally, because I'm not close to retirement, I have some money, I'm still investing in the market. I love those days because everything's on sale, right? It was a great Black Friday, okay? So Black Friday this year, you could go to Best Buy and get a great deal. You could go to the stock market and get a great deal, okay? So if you're still investing, when you see days like Friday, put some money in. Don't throw it all in at once, but maybe put some money in, right? If you're planning to invest that money over the period and you have it, start dipping into the market, right? Maybe today's up. Again, we're recording this Monday. Market's up a bit. Maybe Tuesday drops, right? Get more into the market, right? Dollar cost average into that down market, right? You'll hear it again and again. Buy the dip, buy the dip, buy the dip. And the successful investors, the people that hit retirement with the greatest amount of money, don't panic when the market drops. They take advantage of that. They put more money in the market. Now, we never know when the bottom's here, but if you're in a savings mode, investing mode, start dipping in. Look at it as an opportunity. I always say, when you walk into, Best Buy is a great example. If you walk into Best Buy and you see something on sale, right, you get excited. You might go buy it. Even though you weren't planning to buy it, it's a good enough deal, you're going to go buy it. If you're in savings mode, you need to do that with the stock market. When the investments are down, you need to dip more money in. Sure, what you have is down, but you need to dip more money in. Again, if you're close to retirement, the way to avoid any stress around these down days in the market is to make sure you have a clear laid out retirement plan and income plan. And the amount of income you need over the 12 to 18 to 24 months is put aside. Our clients that use BCV uses a few strategies around this, which I'll go through in the Friday video, that really takes the stress off. Now, my clients will call me and say, Adam, does this derail our plan? What's going on? No, it'll come back. And here, we'll walk them through the process, show them their financial plan. I can even update the financial plan with the down numbers for the day. It doesn't make that big of a difference. The biggest difference it's going to make is if you panic and sell out of your investments. Now you've triggered that loss and you're sitting on the sidelines. You miss days like Monday when the market's up, and potentially, Tuesday, Wednesday, as we go forward. If markets go up or down, they're going to go up long term. We've seen that historically, okay? Now, my last tip for you today. If you are an investor, which 99% of you are, you need to have an accountability partner. And I've talked about this on the channel before. You need to have someone that's going to hold you accountable through days like last Friday. And we're going to have days like last Friday, or even worse, again and again and again and again. How do you react to those days, okay? Ideally, your accountability partner is your certified financial planner, okay? The person that built out your plan, that holds you accountable within that. If you're not working with a financial planner and you don't want to, find someone that you trust. It could be a family member, it could be a friend, a coworker, someone that really understands markets, understands your retirement plan, understands the ins and outs. Okay, it can't be Joe the neighbor that knows nothing about the stock market. Okay, that's not going to help you. That's not a good accountability partner. Okay, again, if you're looking to lose weight, your accountability partner shouldn't be someone that's 50 or 100 pounds overweight. It needs to be someone that's in shape, ideally a trainer, right? It's the same thing on the financial side. Find an accountability partner that can hold your hand. When the market's down and you want to panic, they walk you through it and hold you back from doing so, okay? There's someone that keeps you level-headed when times are tough, okay? If you don't have that accountability partner, find one today, okay? If you take anything from this video, go find an accountability partner. Again, ideally it's a financial planner. But if you don't want to work with a financial planner, that's fine. Maybe you're a DIY investor, you've done it all yourself and you've done very well. Still have that accountability partner. There's stock investing groups out there. There's lots of options. Do your research, find someone or a group of someone that can hold you accountable through the ups and downs of the market. So thanks for joining us in this video today. Hopefully this helps you. Like, if, we're going to have a lot of down days going forward. We'll have lots of down days. Don't panic. Have a plan. Know how that is built into your plan. Know that pulling out of the market, it's going to do more harm than staying in the market. Again, time in the market, not timing of the market. Okay. So hopefully this video will keep you invested, keep your plan on track, and save another day. So we'll see you in the next video.